At this time, it is my pleasure to welcome back to our conference Anirban Basu. Dr. Basu is Chairman and CEO of Sage Policy Group, an economic and policy consulting firm serving clients nationwide. He is the Investment Recovery Association's favorite economist. Dr. Basu provides strategic insights to industries including energy, construction, finance, healthcare, and government. He serves as chief economist for multiple national associations, has taught at Johns Hopkins University and Goucher College, and is frequently recognized for his leadership, including being named one of Maryland's 50 most influential people. Dr. Basu holds advanced degrees from Georgetown, Harvard, the University of Maryland, and UMBC, blending expertise in economics, public policy, law, and health economics. Please join me in giving a warm welcome to Dr. Basu.
Thank you. That was very kind. Thank you. Do my best. Righto. Thank you so much. Good morning. Wonderful to be here. Really, it is, because rarely do I get to speak to an audience that both supports the economies of their enterprises and their communities, but also serves the environmental interests of the entire world. And so I'm delighted to speak to investment recovery professionals. It's an opportunity to talk about the economy and where we are in the business cycle. I'll talk about everything from the global economic outlook to the price of iron ore, et cetera. And I will leave some time at the end of this for questions and answers. So please think about what questions you'd like to ask as I go through the presentation, which is entitled Monetary Masala. It's a play on a 1991 film called Mississippi Masala, starring the two actors you see on the screen, one with whom undoubtedly you're very familiar, the actor Denzel Washington, recently named by the New York Times as the greatest actor of the 21st century. The other actor you might be a bit less familiar with, her name is Sreetha Chowdhury, the Indian-British actress. 1991's Mississippi Masala was her cinematic debut. I've been following her career ever since. In fact, I met her. I met her at JFK Airport. We're on the same flight from New York to New Delhi. I actually, before the flight, approached her, started talking to her, undaunted by her fame. And my very strong belief is, had another 15 seconds, I could have changed both of our lives. But if I'm being honest, the encounter did not work out exactly as I had envisioned. So I'm going to stick with Denzel Washington as the unifying theme of this presentation. And I will talk about tariffs, which of course many of you have been doing already this morning amongst yourselves. I'll talk about immigration policy. I'll talk about all kinds of policies coming out of Washington, D.C. But I want to talk about much more than that, of course. I want to talk about how this policymaking fits into, or does not fit into, global economic dynamics, U.S. national economic dynamics, so on and so forth. If we were in a low interest rate, low inflation environment, these policies would have one set of implications. But as you know, we have been in a high inflation, high interest rate environment. This title slide is a play on a 2009 Denzel Washington film called The Taking of Pelham 123, in which he stars as a train dispatcher. But the Taking of Inflation 2.0, of course, refers to the fact that the US Federal Reserve has as its target for inflation 2% inflation. That's a measure of price stability. And we've not been at 2% inflation in this country for more than 4 years. That burst of inflation shows up in early 2021. And according to the most recent data, we remain ensconced or involved in this inflationary environment. Two measures here of inflation. The green line represents inflation as measured by the core consumer price index. Core means all items less food and energy. Food and energy prices, of course, are important. We'll talk about those momentarily. But we economists often prefer looking at these core measures because food and energy prices are volatile and also be susceptible to non-economic influences like natural disaster, weather, and of course geopolitics. Actually, we had a bit of a natural disaster this morning. As you heard, there was an earthquake in San Francisco, magnitude 4.3. In any case, don't worry, everything seems to be okay. My daughter told me this. She lives in San Francisco. Anyway, setting that aside. Now, if you look at that blue line, that's inflation as measured by the Federal Reserve's favorite measure of inflation. That's the core PC deflator, the core person consumption expenditure deflator. Whether you look at the green line, consumer price index, or blue line, PCE, you can see inflation at 3.1% and 2.9% respectively. And you'll also notice, with respect to both lines, an upward tilt at the end of the series, meaning that the 2% target is proving increasingly elusive. Now, there are many implications for the economy. We'll talk about many of those, but of course there's an implication for the 2/3 of the US economy, that is the American consumer. Let me take you back to May of 2020. Why that month is the baseline. That is the first month of the current economic expansion. America loses 22 million jobs between March and April of 2020. We start to add back jobs in May of 2020. You might remember that governors like Ron DeSantis of Florida and Brian Kemp of Georgia began reopening their economies in April. Not saying that was good policymaking or bad, that's for you to decide. But it did position those states and others to begin adding jobs around that time. And by May of 2020, the overall nation is adding jobs. And according to the National Bureau of Economic Research's Business Cycle Dating Committee, the official end date of that recession was April of 2020. So if you look at prices back then as measured by the Consumer Price Index, May of 2020, and compare those prices to August of 2025, which is the last month for which we have these data, these horizontal bars represent or reflect how much prices have increased over that period. The blue lines down below summarize the headline numbers. So how much inflation overall did America experience in roughly 5 years in a country that aspires to 2% inflation per annum? Around 26%. Strip out food and energy prices, still lofty 24%. Energy prices up more than 50%. Transportation services prices up more than 50%, 53%. There's a neat correspondence between wage pressures and price pressures. Those things move in tandem. And in recent years, certain occupation categories have been associated with especially large increases in compensation. And one of those categories is truck driver. There's been a ton of labor market strife in America in recent years, strikes among actors and writers, Boeing machinists, UAW members of the International Longshoremen's Association. But some negotiations have not ended in strikes. A prominent example of one is the 2023 negotiation between UPS, United Parcel Service, and the Teamsters Union. Those negotiations produced a 5-year agreement, and during the 5th year of that agreement, the average full-time UPS truck driver will be earning $170,000 per year. That's $170K. That's wages plus benefits, plus $170K. Force people like himself to ask the question, how do I look in brown? And based on the app, spectacular. But the point is, when you have that kind of wage pressure, that would also translate into inflationary pressure. Shelter, that's your apartment rents, for instance, up nearly 29%. Food price up 27%. And that's what has many Americans most exercised. It's that grocery bill. Oh, they complain about auto insurance rates, electricity rates, so on and so forth, how much their cell phone costs. But it's that food bill, that grocery bill that has really captured their attention. One of the things I do a lot of as an economist is I speak to a lot of Americans about the economy. And these conversations often transpire in Ubers and Lyfts. Today is no different. I'll be taking an Uber or Lyft from here to Denver's airport to get to the next presentation. And by the way, they've managed to put that airport far from everything. I don't know. Next time I would tell the people of Colorado to put their airport in Colorado. But, setting that aside, there you go. Anyway, setting that aside, many of you take Ubers and Lyfts. And therefore, as a passenger, you're with the driver, you may be less aware that the driver rates you as a passenger. And I very recently become privy to my passenger ratings, and they're extremely low. And you might say, well, that makes sense. You've been speaking now for about 6 minutes. We can tell that it would be that way. But I think this is beyond my personality, that there's something else afoot shaping this outcome, because I take every Uber or Lyft ride as an opportunity to interview an American. And I ask them questions and of course I'm doing this from the back seat, I'll ask the question like, hey, how much do you really make doing this on an hourly basis once you factor in depreciation, insurance, and gasoline? What's your highest level of education attainment? What are the options that you have? Have you ever considered an apprenticeship program? What does your family say about it, about all this? Do you actually view this as a career? Why would you choose this vehicle in particular? And apparently these questions are off-putting. But when you ask them about the economy, one thing they complain about is right here, they can't keep up. And now, of course, President still, in his first year, I'll go back to those previous 2 slides, he's putting forth some policies that one could argue are inflationary. I'm not making any value judgments about these policies. That's not my role here, not at all. I'm simply suggesting as a macroeconomist that some of these policies could be inflation, meaning could put further upward pressure on prices. I called this slide the Manhattan candidate, because there's, of course, some affinity between Donald John Trump and Manhattan, also Queens and Mar-a-Lago. But also, this is a play in a 2004 Denzel Washington film called The Manchurian Candidate, in which he plays the part of Major Bennett Marco. Now, tariffs, of course. Whether on nations, 50% on India, for instance. By the way, the Trump administration, as you know, just announced that H-1B visas issued will require a $100,000 payment. That probably is largely targeting the Indians, because about 71% of all H-1B visas are issued to Indians. The next is China at 12%. In any case, there is that trade war transpiring along multiple dimensions. The Chinese, for their part, face a 55% tariff, the Europeans 15%, the English 10%, so on and so forth. And that would tend to be inflationary. Then, of course, perhaps more importantly for this audience, tariffs against certain items of interest. 50% tariff on steel and aluminum. Those 50% tariffs came into force June 4th. And then, of course, 50% tariff on copper, again, would tend to put upward pressure on prices. This is a tax on U.S. importers, as everyone knows. Then the passage of the One Big Beautiful Bill. Now, of course, a lot of business operators are very thrilled about the One Big Beautiful Bill, the restoration of 100% bonus depreciation, those kinds of things. By the way, the pickup investment that transpires because of all of these tax benefits from the One Big Beautiful Bill will translate into more investment recovery later on, right? Whatever creates more investment now translates to more investment recovery at some point in the future. But the Congressional Budget Office, nonpartisan, indicates that that bill will add $3.4 trillion to national debt, which is currently around $37.5 trillion. It'll add another $3.4 trillion over the next 10 years. And to the extent that that pushes more money back into the economy, that would tend to be inflation, and then finally mass deportations. And I understand very well that the southern border is an issue for many Americans. I understand that. So again, I'm not making valid judgments about these policies, not at all. That's not my role here. One of the things I do a lot of is I watch a ton of Fox News. I do. I watch a ton of Fox News, and I watch a ton of Fox News because my mom makes me. So my mom and dad live 4.5 miles away from me in Baltimore County, Maryland. And I visit them, quite frequently, and my mom likes to spend time near the kitchen. As it turns out, she has a nice TV there, and she watches Fox News all day, every day, without exception. My father is the other part of the house. They have a reasonably nice place, and so there's some distance there, but he's in his home office, and he likes to play online bridge, he writes, he's taking up the guitar, so on and so forth, and he watches CNN all day, every day, without exception. And so then, and this is inevitable, they meet sometimes. Sometimes in the living room, they encounter one another. And then all heck breaks loose and I leave the parental home. But I understand very well the southern border is an issue, but to the extent that that truncates the size of the labor force, whether in construction, landscaping, agriculture, food processing, leisure and hospitality, you name it, industries that have been particularly aggressive in utilizing the services of undocumented migrants, that would tend to be inflation. Now, I skipped 2 slides, let me go back to these. This is the producer price index for steel mill products. I spoke at a steel conference recently in Atlanta, Georgia, and it was interesting because one might have thought that with these 50% tariffs in place, that the price of steel would have surged higher. In fact, what they told me is no, demand is weak for steel, and so the tariffs are acting more like a floor than pushing prices up to the ceiling. And so you can see there, after an initial bump up in steel mill product prices, they've actually come back down just a bit and actually quite low by post-pandemic standards. This is the iron ore spot price, and I'll show you later on in the presentation more data regarding iron ore, but you can see, you can't tell that there are any tariffs in place based on the trajectory of this price. And again, a lot of this has to do with the fact that the global economy is weak and putting downward pressure on metals prices, but much more about that as we go through the presentation. Okay. Now, here's the thing. Despite all these headwinds, all this uncertainty coming out of Washington, D.C., the U.S. economy has continued to perform. It's continued to perform despite the presence, for instance, of high interest rates. So the Federal Reserve is looking at all these data and asking the question, what do we do about interest rates? This is a primary mechanism for influencing economic growth, the federal funds rate, also known as the Fed funds rate, also known as the overnight bank lending rate. This is the rate at which banks can borrow from one another overnight. And why would a bank do that? Because banks require a certain amount of reserves inside the bank to make loans outside of themselves, and occasionally banks run up against that constraint. When this rate is set at a low level, banks are more likely to borrow from one another, thereby shoring up their reserves, thereby lending more aggressively than the economy. When this rate is set at a higher level, of course, an opposing behavior ensues. As the pandemic overtakes the economy, the Federal Reserve pushes interest rates as close to zero as is possible. Here I'm graphing through the upper limit on the federal funds rate. So the minimum possible here is 0.25%. That burst of inflation shows up in early 2021. But in 2021 itself, the Federal Reserve does nothing about that inflation. They don't try to slow the economy down. It's a very uncertain period, obviously, but they also view that inflation to be transitory, purely supply chain driven. The notion had been that as supply chains normalize, inflation would just naturally abate to that 2% level we'd enjoyed for many years prior to the pandemic. Instead, the Federal Reserve presides over the creation of a wage price spiral. So prices take off in early 2021. Employees notice, boss, I need a raise. I cannot afford my life. Boss says, no problem, I'll give you a raise. I need you. The economy's coming back very, very quickly. I'm having a difficult time getting other people back to work. I'll just pass along my cost increases to my customers and clients. Wage price spiral. And after about a year of this, the Federal Reserve begins to push back on inflation. March 17th of 2022, the process begins. That day they raise rates 0.25%. But even then, they're only dipping their toes in inflation-fighting waters. But after that, they get more serious. Next meeting, 0.5%. Next 4 meetings, each meeting 0.75% increases in the federal funds rate. Then back to 0.5, then 0.25, then 0.25. May 3rd of 2023, 0.25. Pause in June of that year, July 26, 0.25. Then pause for 8 straight meetings. That's that flat spot that you see toward the right of the slide, the northeast part of the slide. And then late last year, the rate cutting begins, September 18th, half a percentage point rate cut. Remember, it was about a year ago now. It was almost precisely a year ago. The stock market rallies on that. Then 2 days after election, November 7th, another quarter point rate cut. December 18th, a quarter point rate cut. And then they pause for much of 2025 until last week. And I'll explain to you why the Federal Reserve has altered its strategy for interest rates. But they cut interest rates, as you know, a quarter point last week. It was on Wednesday. And so now the federal funds rate had been 0.25% upper limit. Goes to 5.5% during the cyclical apex, is now down to 4.25%, but this chart is pretty clear. Interest rates are still quite high. Interest rates are higher than they were for much of the post-pandemic period, that's for sure. Nonetheless, the U.S. economy has continued to perform quite nicely. As you know, the stock market entered this morning at record highs. NASDAQ, S&P, Dow Jones, all at record highs. It's down this morning, as it turns out. But the U.S. economy, by and large, has performed quite handsomely, and the broadest indication of that is right here, growth in gross domestic product, quarterly data, annualized rates of growth. In 2021, the U.S. economy grows handsomely, 6.1%. 2022, it grows handsomely, 2.5%. 2023, even more handsomely, 2.9%. Last year, 2.8%. So the U.S. economy is performing, but if you look at the last quarter for which we have data, that's the second quarter of 2025, that's the quarter in which the U.S. economy expanded 3.3% on an annualized basis. Now you might point out to me, Anirban, isn't it true that the U.S. economy shrank during the first quarter of 2025? Yes, it did, 0.5%. Should we be concerned about that? Not at all. And why shouldn't you be concerned? Because of the nature of how we account for GDP, gross domestic product. The GDP is our primary measure of national output, as you know. Though growing up, many of us talked about what? Gross national product. Gross national product is the output of a nation's citizenry, irrespective of where they live. It could be Hong Kong, Dubai, Venezuela, wherever they live. Gross domestic product is the output that transpires within a nation's boundaries. In any case, the first quarter we shrink, but the GDP accounting equation explains why. You'll remember this perhaps from school, if you had the benefit of taking Introduction to Macroeconomics, which you may have taken as a requirement as opposed to as an elective, but setting that all aside, and you'll remember that that equation was y equals c plus I plus g plus e minus m. And that, I don't think, has to be explained any further. Though I will take some time, just in case there's someone in the audience who is not remembering this equation. So y is our abbreviation for output, which again, we tend to measure in the form of gross domestic product these days. Y, output. Output equals the uses of output. What are the uses of output? C, consumption, that's consumer spending, plus I, that's business investment, plus G, that's government spending, plus E, that's exports, what we produce in this country but sell abroad, minus M, what's produced abroad but sold in this country. The point of that equation is that M enters the equation negatively. As imports go up, output goes down. Well, what were we doing during much of the first part of the year? We're buying a ton of imports to circumnavigate tariff pricing. So having bought all those imports during the first quarter and driven GDP into negative territory, less need to do that perhaps during the second and third. Those inventories had been stocked. And so second quarter GDP 3.3%, the Atlanta Federal Reserve maintains a product known as GDP Now, which estimates current quarter GDP, and their model suggests that the U.S. economy during the current quarter is also on pace to grow 3.3% on an annualized basis. I suspect that that's going to be revised down into the mid-twos at some point, but the point is that's not recession. And at the core of that ongoing economic momentum has been that fighting force known as the American consumer. These are monthly retail sales. We just got the August retail sales. They were strong. Oh, you hear stories about Starbucks, a few weak orders. So actually Starbucks, in the last few months changed their CEO. The previous CEO was a guy named Lakshman Narasimhan, who looks just like me, as it turns out. The new CEO is a guy named Brian Nickel, who looks nothing like me and came over from Chipotle. But the point is, you do see some weakness in certain segments of the economy, including those discretionary spending categories, and we'll talk about why that is in a moment. But you can see from the overall retail sales numbers, the August retail sales were up 0.6% for the month, strip-out cars 0.7%. The consumer is still active. And by the way, much of the growth in consumer outlays recently has not been on retail items here depicted, but rather on services, things like travel. So if you look at people passing through TSA checkpoints, the number of Americans passing through TSA checkpoints recently has been about 1.5% above last year's tally. Well, last year was a good year for travel. This year slightly better, even though international travel to the US has fallen off quite sharply, particularly from Canada, as you know, but some other countries as well. They're spending on Beyonce concert tickets. They're spending on Taylor Swift concert tickets. In August of 2023, the average price of concert ticket purchased on resale, and that's how Americans buy them on resale, sold for $1,690 per ticket. She sold at football stadiums in the country multiple times, often same city, same week. She just toured Australia, parenthetically. The Australian government thanked her for improving their economy. She generated about $300 million of economic impact in 5 days. She's not merely a musical phenomenon, she's an economic one. And I would say to you that this thing between her and Travis Kelce remains the greatest thing going on in America. This is fabulous. This is precisely what this nation needs during these tumultuous times. It's really brought us together as a people. Otherwise, I think we'd be quite divided as a people, politically and otherwise. But we're not, are we? We're united. So in any case, now, I'm going to make the case later on during the presentation that the consumer cannot continue to spend as they have been, but not yet. Because here's something else that happened during a period of high interest rates that I would not have anticipated. America got much wealthier. This is total US household wealth. Back in 1990, which was not that long ago, total US household wealth was sitting at $20 trillion, and we thought we were a pretty wealthy society back then. It ends last year and begins this year at more than $160 trillion, and this does not even take into account the recent surge in US stock prices. And of course, to the extent that you have more wealth in the economy, that would tend to engender more spending, though you might point out to me, and by the way, these are Federal Reserve Bank data, you might point out to me that that wealth is not neatly distributed across the American populace, which is what this slide gets at. Also Federal Reserve Bank data. Here I'm simply stacking the most affluent households in America down through the least affluent and ask the question, where does the wealth reside in America? So I'm breaking things down by percentile. So if you look at that light green slice at the very top, that's the wealth controlled by the top 0.1% of Americans. There are about 340,000 of them in terms of members of those households. This is the 1 in 1,000 or better household. And they control about 13.8% of the nation's wealth. The darker green slice below that is the wealth controlled by the balance of the top 1%. That's your 99th percentile, your 99.9th percentile. They control 17% of the nation's wealth. So the top 1% controls about 31% of the nation's wealth. The yellow segment below that is wealth controlled by the balance of the top 10%. So that's your 90th percentile to 99th percentile. They control 36.4% of the nation's wealth, which means that the top 10% controls almost precisely 2/3 of the nation's wealth. The orangey segment below that is the wealth controlled, or brown segment, is the wealth controlled by the 50th percentile to the 90th percentile, so that's 40% of America's population, and that 40% controls 30.3% of the nation's wealth, which means that the bottom 50% of America controls 2.5% of the nation's wealth. Top 50%, 97.5%, bottom 50%, 2.5% is two different nations. From a wealth, and politically maybe it is two different nations, but also economically, macroeconomically. From a wealth profile perspective, America's two separate nations. You can call it haves and have-nots, haves and have-less, or haves and have-yachts. Whatever you want to call it, you can call it. But that's the way it is. And of course, a lot of these people in the bottom 50% are homeowners. The U.S. home ownership rate is above 65%. So they have equity in their homes, but they have very little financial wealth. They live from paycheck to paycheck or on fixed incomes. And what do you need in a nation with so much wealth disparity, so much wealth inequality? Well, it's obvious, isn't it? It's readily apparent what you need. You need an equalizer. This is Denzel playing the part of Robert McCall. This was such a good movie, they effectively made it 3 times with almost no change in plot. And because the first one was good, the second 2 were good as well. So, and what has been the great equalizer? It's been that labor market. I mean, what has been one of the great challenges for you as professionals? Finding people to do the work. Constant labor force challenges. Though recent data indicate that the labor market is starting to weaken. For instance, if you look at the JOLTS, the Job Openings Labor Turnover Survey, we saw in July another decline in job openings in this country. You perhaps heard that this is the worst job market in recent years for recent college graduates. We now have more unemployed people than job openings for the first time in years. 7.4 million unemployed people, 7.2 million job openings as of July. You can see from the monthly job growth or job change numbers, job growth has really softened. This is that slide. This is that headline number that comes out every Friday, first Friday of the month. The last month for which I have data here is August of 2025. We added 22,000 jobs, but in a country of 340 million people, that's almost nothing. That's basically zero. And it's been zero for several months now, effectively, statistically. I had been able to say for a few years, my goodness, the last time we lost jobs as a country was December of 2020, which happens to be the bar on the far left-hand part of the slide. That was a COVID-intensive month, but through wildfires, hurricanes, bridge collapses, elections, you name it, America had managed to add jobs ever since on a monthly basis until June of 2025. Revised data indicate that we lost 13,000 jobs that month. You might have also heard that the Bureau of Labor Statistics, which produces these data, recently revised lower its estimate of job creation for a year-long period ended March of 2025 by 911,000. So it was a negative 911,000 job adjustment. You may have heard that, and you might ask the question, Anirban, is that reflected in your slide? And the answer is, no, it is not. So why is that, sir? Is it because you're political? Is it because you're lazy? I'm lazy. Not that political, but it's not. That's not why even. That negative 911,000 revision for the period April of 2024 to March of 2025 was a preliminary revision and will therefore not be sewn into the data until February of 2025. So let me give you a sense of the magnitude of this. According to the unrevised data, which is what you're seeing here, between April of 2024 and March of 2025, America on average added 146,000 jobs per month. You strip out the 111,000, at least what will happen in February, around that, that's 76,000 jobs taken out of the jobs numbers per month. So that 146,000 goes to 70,000. And that's one of the reasons the Federal Reserve really changed gears. Not only at their last meeting did they announce that we're cutting rates now by a quarter point, but they also said we're going to cut rates probably in October and December. And the stock market rallied on that last week, that news. And it's because the new data indicate that the economy has been softening for longer than they thought and more sharply than they thought. Still, you can see retail spending, we're still adding jobs, so on and so forth. And of course, some regions continue to outperform others. And that's what this slide gets at. But this is a long-term perspective on things. This is employment growth for the 25 largest metropolitan areas in our country. February of 2020, why February of 2020 is the baseline, that's the last month before we shut down the US economy. So the public health emergency was declared March 13th of 2020. So I'm taking you back to February of 2020, looking at jobs supported by these 25 quite large communities back then, and comparing those job totals to August of 2025. The left-hand column includes those regions that have added jobs the fastest. Now, Austin, Texas recently supplanted Portland, Oregon to become the 25th most populous metropolitan area in the country. So Austin is on this chart, Portland is off. Austin, you can see, could have its own column. There is no boom town like Austin, Texas. And so much of that growth in Austin has been technology oriented, as companies like Apple and others have established major campuses in the Austin metropolitan area. Number two is Dallas. In recent years, no region of the country has added more people in the Dallas metropolitan area. And again, there's a neat correspondence between population growth and job growth. Those things move in tandem. North Texas has been booming. Lots of mega projects, semiconductor plants, those kinds of things. But also flat land, significant rainfall, very developable, favorable zoning policy, favorable tax policy, lots of infrastructure leverage. By the way, no region of the country overpays their quarterback as much as the Dallas metropolitan area, but I'm persuaded that those things are purely coincidental. But it's the American South, isn't it? It's Austin, Dallas, Orlando, San Antonio, Charlotte, Tampa, Phoenix, Atlanta, Houston. That's where the population growth has been. That's where the job growth has been. I think that Houston market, and they've got some infrastructure challenges in Houston, those kinds of things. But that Houston market is going to be phenomenal going forward. That's our energy technology capital. And of course, lots of progress to be made in terms of energy technology going forward. The Northeast corridor, for the most part, is in the second column, the right-hand column. New York Metro, Maitana, Baltimore, bless you, Washington Metro, and Boston. One of the things that many Americans have been searching for is affordability. So they've often been leaving behind very expensive metropolitan areas. Now, Boston is wickedly expensive, as you know. So you've seen some centrifugal force pushing people out of the Boston area into surrounding states like Maine, New Hampshire, et cetera. And then two very expensive markets bring up the rear there, the Los Angeles and San Francisco, California markets respectively. You also see the monsters of the Midwest there, the very large Midwestern markets, Chicago Metro, Detroit, Minneapolis, St. Louis, also clustered in that right-hand column. Lots of mega projects in the Midwest, but still low population growth, relatively slower employment growth. Now, next slide, same 25 major metropolitan areas, but instead of employment growth, these are rates of unemployment. And now you see a new story emerging in America. If you look for the bottom of the right-hand column, so for instance, New York Metro, 5.1%, San Diego, 5.2%, Detroit, 5.7%, LA, 6%, Riverside, 6.4% unemployment. Don't mean to make a mountain out of a molehill. 6.4% unemployment is not astronomical. For instance, in Canada, unemployment rate nationwide is 7.1%, 7.7% in Ontario. But these rates of unemployment are higher than they were. And again, what that suggests is the economy is in fact slowing, and that virtuous cycle is starting to break apart a bit. Of what does that virtuous cycle consist? Consumer spending, impact employers' hiring, which fuels further spending. Now, we'll talk more about the forecast going forward, but let me take you to the next part of the presentation, which is entitled Devil in a Bunch of Data. And this is a play on a 1995 film called Devil in a Blue Dress, in which Denzel Washington stars as a very handsome Easy Rawlins. I think an element of being the greatest actor of the 21st century is being attractive. And Denzel is that. He's a very good-looking gentleman, dare I say, gorgeous. And I'm married to 2 children, but I can still tell. So anyway, so let me talk about some risks to use, kind of beyond tariffs and policymaking coming out of Washington, D.C. or interest rates. If you're going to start with a discussion of risks to the U.S. macroeconomy, you have to start with the consumer. You cannot have an economic downturn unless the consumer participates. Oh, the consumer is seldom an instigator of the downturn. For that, you need the commercial real estate debacle in the 1980s and the tenant savings and loans crisis. Or you need the dot-com bubble bursting in 2000, followed by the 2001 recession. Or you need the housing bubble bursting in 05, 06, 07, followed by the 07 through 09 recession, or you need COVID. But at some point, the consumers got to become involved in that dynamic for there to be an economy-wide, full-fledged economic downturn. And thus far, the consumer has not been engaged in the dynamic. But can they continue to spend as they have been? That's the question. And that brings me to an analysis from the Federal Reserve Bank of San Francisco. And the metric of interest here is personal or household savings measured in hundreds of billions of dollars. So that green line at the bottom of the slide is household or personal savings. And you can observe as we move toward the pandemic a reasonably smooth trajectory in household savings or personal savings, but then the pandemic changed everything. Because during the pandemic, many Americans received stimulus payments. Many business operators received paycheck protection and other forms of support, including some businesses that may not have required all of that support, including the Los Angeles Lakers. And of course, many workers experienced meaningful increases in compensation during that period. So for many American households, household income is rising precisely as their expenditures are dwindling because they're not taking vacations. They're not seeing movies or plays. They're not seeing Beyonce or Taylor Swift in concert or even Ice Spice or SZA. And so according to the Federal Reserve Bank of San Francisco economists, the pinnacle, the American household amassed about $2.1 trillion in excess savings, meaning savings above and beyond what they were, say, but for the pandemic. According to those same economists, those same households spent down $2.4 trillion of those savings. All those household savings are gone. Now, as those savings hit the economy in the form of expenditures, it juiced the economy. Look at the back half of 2023, 4.4% growth during the third quarter of 2023, 3.2% on an annualized basis during the fourth quarter, and then again 2.8% for all of last year. Fabulous. But now what are you left with increasingly? A consumer who has spent down their pandemic-era savings and continues to face high and rising prices. Now, having spent all that money, many of these consumers have improved their living standards. They live in nicer apartments now. They drive nicer vehicles. They wear nicer clothes from Lululemon and Vuori. They've dined at finer restaurants. But now they've spent down their money and their savings, and the prices keep rising. So how do they maintain that sort of living? Well, of course, you just turn to the credit card. New York Federal Reserve Bank data regarding U.S. credit card debt. You've heard that credit card delinquency is up. You've heard that mortgage loan delinquency is up. You've heard that apartment rental payments are often delayed now. You've heard now that student loan repayment policies have changed. All loan delinquencies are up. So more and more households are under stress. Not the top 1%, they're fine. Yeah, Bitcoin fell overnight to 111,000, but they're still fine. I'm not worried about Jeff Bezos, for instance. I spend very little of my time as an economist worrying about Jeff Bezos, even less about Tom Brady. But it is, again, that bottom 30, 40, something percent that probably is suffering right now from a loss of living standards, facing more financial pressure, dining out less, those kinds of things. Now, the pandemic has left behind some other lingering legacies. So I know that return to work has been a big theme this year. And indeed, 54% of those working for the Fortune 100 in this country are full-time back in the office, 5 days a week. You know, you've heard Jamie Dimon at JP Morgan, for instance, insist that his workers come back 5 days a week, that kind of thing. But it is still the case that work from home is very popular, whether among small businesses, technology firms, so on and so forth. And that creates a legacy of these very high office vacancy rates around the country. These data come from CB Richard Ellis, CBRE. San Francisco, 35% vacant. That's a big town. You've seen the Chicago skyline. It's glorious, as is Seattle. It's 27% vacant. Now, we care, of course, about the building owners, their loss of revenue, their loss of rental income, but their banks have a fair amount of exposure to this. Like, let me give you an example of what's been happening in America. About 8 months ago, the Wall Street Journal penned an article featuring downtown St. Louis. Now, St. Louis, as you know, is a beautiful, historic American city. And the tallest building in downtown St. Louis is the 44-story AT&T building. In 2006, that building sold for $205 million. It just sold for $3.5 million. Somebody takes that loss. Could be a bank. It could be a series of equity holders in the building who chase that valuation downward from purchase to purchase, because that could be some bank's collateral. 1 South Street in my city of Baltimore used to be the Alex Brown building. It's now the Stiefel building, a very prominent fixture on our skyline. In October of 2015, that building sold for $66 million. It just sold for $24 million. And a major U.S. bank took a haircut on that deal. And we are starting to see a pickup in commercial real estate foreclosures. And then on top of that, of course affects local and state tax bases, particularly local and city tax bases. So a lot of cities are facing fiscal stress. So spending among state and local governments has been a driver of economic activity for the last few years. Post-stimulus, March 11th of 2021, President Biden signed the America Rescue Plan Act of 2021, which among other things provided $350 billion of support to state and local governments. That money by and large has been spent down, and now cities are left with fragmented finances. So, for instance, this first bullet, with the city facing a projected $1.12 billion shortfall in 2026, Chicago Mayor Brandon Johnson said recently, quote, "We have reached a point of no return," close quote. That is not inspiring, by the way. I don't know if he's running for re-election or not, but that is not inspiring. Between December 2024 and April 2025, Chicago, LA, San Francisco, and Washington all experienced credit rating downgrades. According to research conducted by the Pew Charitable Trust, at least 20 of the nation's 25 most populous cities have reported budget gaps for fiscal year 2026 and often beyond. And of course, cities depend more upon commercial real estate tax base than residential real estate tax base on average, at least relative to the suburbs. And so it's not surprising that you would see these outcomes. Okay, let me very briefly talk about the US housing market, and then I will conclude with the forecast. And I use this movie as a segue, 2016's Fences. This was a critically acclaimed film in which Denzel stars as a Pittsburgh-based sanitation worker, And this stands for the proposition that Denzel Washington can look good doing anything, even if it involves being in the city of Pittsburgh. So let me show you some more data on interest rates, because interest rates are the most important price in the economy. 30 fixed mortgage rate in blue, 50 fixed mortgage rate in green. These data come from Freddie Mac, they're weekly data. And for the last week for which Freddie Mac data, the average 30 fixed mortgage rate is sitting at 6.26%. And you say, Anirban, you, sir, have a tendency to sensationalize, but even you cannot make a big deal out of a 6.26% 30 fixed mortgage rate, because I can remember when mortgage rates were 21%, 18%, 15%, 13%, fair enough. But to millennials and Generation Z, the youngest members of our workforce, these rates are preposterously high. And that's what's really dropped out of the single-family home purchasing marketplace. It's been that would-be first-time buyer, frustrated by lack of inventory, high prices, and by their standards, extremely high borrowing costs. Now, as I move toward the tail end of this presentation, I'm going to share with you some leading economic indicators, because I want to pivot from a discussion of what's been occurring to a discussion of what's likely to occur going forward. Here's a leading indicator, home sales prices. So this is the S&P Case-Shiller Home Price Index by metro area. These price increases are not sustainable. And we're starting to see now, just in the last month, some of these prices were down. But this is on a 12-month basis. So S&P Case-Shiller Home Price Index by metro area, New York got 7% more expensive over the last year. New York was already expensive. It got another 7% more expensive. It's not sustainable. Chicago, you've heard about their city finances. Nonetheless, home prices explode there. I think some of the markets at the bottom are foreshadowing. Tampa, negative 2.4% over the past year. Though that might have something to do with the fact that that state's property and casualty marketplace is broken down. It's very expensive to get insurance there, as you know, particularly in coastal Florida, but even in places like Orlando. And so if the cost of owning a home goes up, it means that buyers are less willing to pay a meaningful price, and so home sales prices are falling there. But this is something to watch for going forward, and this will put even more pressure on state and local governments, if I'm right, that home sales prices are not going to continue to rise as they have been. Another leading indicator, U.S. residential building permits. Permits are a leading indicator because if you're a builder, you've got to pull a permit before you build. This whole housing cycle is falling apart. The orange line there is single-family building permits. You can see it's falling apart. Mortgages are high. People are uncertain. And it's hard for millennials. The oldest of the millennials will turn 44 this year. And it's hard for them to save up a down payment when they're paying so much for rent and groceries and all the rest of it. So they're frustrated as a generation. There's some millennials in the audience. I'm quite sure if I met them, I would not like them. But the point is, I can understand why they whine and moan so much. There's reason for their frustration, and the latest source of frustration is this right here, the housing market's operation. Multifamily rates to future apartments to be constructed. You can see that's coming down. U.S. construction is losing employment. So there's parts of the economy that really are falling apart, particularly those interest rate sensitive segments of the economy. Here I'm juxtaposing two data series for you, just to give you a sense again of what's happening. The green line there is housing units under construction. That's fallen quite sharply, you can see on the slide. The blue line is employment among residential contractors. That has not fallen. So you have increasingly idle construction workers. Now, why aren't they being let go, released from employment? They're not being released from employment because it's so hard to find them in the first place. There's a skill shortage in construction, so employers are reluctant to let them go, even if they're becoming idle. But at some point, if housing units under construction continues to fall, and I predict that that will happen, you're going to see some layoffs here. And again, I'm using that as a leading indicator to suggest there's growing pressure on the U.S. economy. You're going to see mounting layoffs in certain categories. Enough of that, let's turn to the forecast. And the glory is yours because this presentation is almost over. But let me show you again some more things that might lead the economy. So this is GDP growth, US versus the globe, 2019 through 2026 and 2025 forecasts. So the green line or bar here is United States, blue is the world. My point is the world economy has become quite weak. The forecast from the International Monetary Fund is the global economy will grow 3% this year and 3.1% next year. Global economists often define anything less than 3% GDP growth globally as being global economic recession. We're right there. You can see the outlook for the US, by the way. So last year, again, we grew 2.8%. The outlook from the IMF is 1.9% for the US the current year and 2% next year. But I find some of these forecasts to be a bit optimistic, but we'll see. This is just breaking down the 2025 projection. I apologize for the very small type. It's a big world with lots of countries. But you can see at the top, that blue-colored bar at the top, 3% forecast for the world. You can see also for the United States, 1.9%. Canada, if you're interested, 1.6%. But the biggest reading here might be China. Because China, of course, is a massive user of commodities like metals. And it's really that China's economic weakness that has changed the outlook for metals prices and the metals complex generally. More than any other factor, the forecast is for that economy to grow 4.8%. And I say, but look, sir, it's late September, and you're showing us 2025 forecast. We're almost through the year. What you really should have done, sir, is shown us 2026. That would have impressed us. That would have engendered some cheers if you'd done that. Okay, here it is. So 2026 is a projected growth, again, for the International Monetary Fund. Again, you can see a 3.1% outlook for the world. But again, toward the bottom of the slide, you can see China, the emerging country of the world, on the bottom half of the slide. China, 4.2%. That is just not an environment in which you expect metal prices to surge, even with US tariffs and efforts by the US government to increase metal production. So if you look at metal price forecasts for 2025 in green and 2026, this is year-over-year percentage change. Aluminum is the first couplet on the left-hand side, then comes copper. Then comes iron ore, which we talked about iron ore at the beginning, but these are all the forecasts. Lead, nickel, which of course is very important to this industry, tin, and zinc, with the exception of tin, not great outlooks here. Even tin is, modest. So, and again, why is that happening? Because the global economy is weak, and when you've got a trade war, and again, I'm not suggesting it's good or bad. I understand the US government is trying to achieve some laudable goals with these tariffs, trying to reindustrialize America, national security issues, so on and so forth. But nonetheless, this creates some tumult in the markets in the short term. This is iron ore prices, just a breakdown. The green color bars at the end there are 2025 and 2026 forecasts respectively. Just, it's just a weak global economy, and so you would not expect to see a lot of vigor in some of these prices. And obviously for people who are trying to recover investment, it's going to be harder with these prices sagging, some of these prices sagging. That's all I'm suggesting. So we need the global economy to really come back. There's other pressures on the global economy besides trade wars. There's sovereign debt, for instance. whether in the US or Europe or elsewhere, also constraining governments in terms of how much they can reinvest into their societies. Major bank forecasts for US GDP growth, I pointed out that the IMF forecast for US this year was 1.9%. Major banks have a somewhat more tepid outlook. Morgan Stanley, Bank of America, Goldman Sachs, Wells Fargo, JP Morgan Chase, all between 1.5% and 1.9%. So the IMF forecast is the upper range of these forecasts here. In a typical year, the risk of recession is between 10 and 15%. They're actually quite rare events in America these last few decades. But the recession probability as projected or concluded by major brokerage forecasts, Goldman Sachs, Wells Fargo, JP Morgan, between 30 and 40% risk of recession in 2025. So the economy is fragile, there's no question about that. And yet the stock market surges. And that makes me nervous, actually, when the stock market surges as the economy is weakening, because that's exactly what happened in 2007, by the way. I'm not predicting we're going to have anything like 2007, 2008, 2009. I'm not saying that. But you might remember the stock market peaks in October of 2007. 2 months later, we're in recession. So it can turn around quickly. I still don't think recession is likely, and it's for the reasons on this slide, or some of the reasons I'll give as I go through this slide. Because we're out of time. Though Out of Time, as you know, was also a 2003 Denzel Washington film that also starred Eva Mendes. Though I've not managed to meet her, I am trying. So inflation is poised to stage a comeback. I blame tariffs for that, but also immigration policy. Whether affecting food prices or other prices. Interest rates poised to be higher for longer. Not the short-term interest rates managed by the Federal Reserve. I'm not talking about that. I'm talking about the interest rates that you and I transact at. The line of credit, the 30-year fixed mortgage rate. You might notice in the last few days that the yield on the 10-year treasury has actually been popping higher. As I got up here sitting at 4.13%, had been 4.04% for much of last week. So short-term rates can do one thing, let's say fall because of the Federal Reserve. Longer-term rates can go up at the same time. Why is that? Because longer-term rates are anchored by inflation expectations, and those seem to be rising. Many consumers are exhausted financially, and their circumstances could worsen because, if I'm right, prices are going to accelerate. Price increases will accelerate. Are asset prices overextended? They might be. What goes up can come down, as we know. This may have something to do with tariffs and other uncertainty facing the global economy. So forecasters for growth in 2025, I still think it is. How is a recession defined? A recession is defined as a significant decline in economic activity that has spread across the economy and lasts more than a few months. We are in late September, or late-ish September. In early 2026, you're going to start to see some real tax benefits coming out of the One Big Beautiful Bill, including massive refunds for certain Americans in February and March of next year. The IRS, as I understand it, has not altered withholding schedules. We have a $40,000 SALT deduction that is retroactive to January 1st of 2025, and some other tax breaks that are retroactive to 2025. So you're going to see a huge infusion of cash into the economy in early 2026. We don't have enough time to get to a recession. That's what I'm suggesting to you. So I still think the chance of recession is quite low. So forecasters for growth in 2025, I still think it is. And we'll see a bit of a rebound in economic growth in 2026. But there are risks, including rising interest rates and falling asset prices. If the stock market really crumbles, that probably would be enough to bring us in a recession. The economy is fragile enough for that, but you can't predict that as part of your baseline forecast. So that's my outlook. If you like this kind of data analysis, I have a newsletter at www.sagecon.com. There's a free service here. So I'm not necessarily down for dollars. If you're not interested in the newsletter, please, anytime, feel free to go ahead and pound sand. And with that, hey, thanks a lot for the opportunity. It's been a privilege. Hopefully I've left some time, I think I have, for Q&A. Thank you very much. Yes, please.
How concerned are you about the trustworthiness of federal economic data moving forward?
Right, so the question is, you heard it, how trustworthy are the data? I will tell you this. I have probably throughout my career over-relied upon these data. And why have I done that? Because there's only data that I can rely upon. Right, so when I see, no one else is reporting on national employment other than ADP, for instance, but they only cover the private sector. They don't have public sector estimates. So no one's actually covering every single industry's employment. Only the national government has the size and scale to do, the size and scope to do that, so they do that. So I have to rely upon those data. But all the while, I've recognized that there's huge errors, ranges around these estimates. So for instance, let me give you an example. I mentioned that in August, America, according to the preliminary estimate, added 23,000 net new jobs. the range of error around that estimate is 140,000 in each direction. So we economists, it's 23,000 jobs. We added 23,000 jobs in August. We added around 23,000 jobs, but it could have been a negative 117,000. It could have been, almost 200,000. So I've over-relied. And now, given one, budget cutbacks at the Bureau of Statistics, so they've got many fewer economists there. And by the way, I know a lot of these economists. I went to school with them, Maryland and some other places that I went to. I went to a school of public policy, and so a lot of these people went into the federal government and they're analysts. So I know these people. These are people who have never dated. They just focus on their spreadsheets. They're really good statisticians. That's all they do, right? They have pasty skin. Anyway, the point is they're honest, but there are fewer of them. And so what they have to do when they can't collect enough data, they impute. What does impute mean? Filling in the blanks. And now when you get political pressure to come up with certain answers to the question, how do you impute? Do you impute in an objective, unbiased way, or do you impute in a way that generates a certain answer? How many jobs do we add? How low is unemployment? That kind of thing. So I am having to look more aggressively at data produced by the private sector. Thankfully, there's a fair amount of it, whether it's ADP jobs. I think you're going to see more and more people focus on the ADP jobs number, which comes out the Wednesday before the Friday Bureau of Statistics jobs release. You're going to see more of that going forward. That's all I can do is I have to look at the Realtors Associations and others to figure out what's going on in the economy, Institute for Supply Management to see what's happening in manufacturing, in the service sector, so on and so forth. Because I cannot rely on the federal government data as much as I had been, and I probably over-relied in the past anyway. So I'd be making some adjustment anyway. Any other questions here? Yes, please.
Thank you. That was a great presentation. I'm curious what your opinion is on the impact of AI on the unemployment stats that you shared.
Right. So the question is, that's a tough one, and you're going to get a very, very excellent speaker talking about AI, but it's a great question. I think it's quite significant, and I'm in the minority on that. So a lot of economists would say, well, we've seen an increase in unemployment from 4% to 4.3% over the course of the year, and that's really because of economic slowing. I agree with that part. But when you break things down demographically and look at where the unemployment rate has risen, it's risen in particular among entry-level white-collar workers. Well, which segment of the economy right now is most impacted by entry-level white-collar? Which segment would be most impacted by artificial intelligence's impact on the economy? It's entry-level white-collar workers, right? It's your entry-level computer programmers, for instance. It's people who are in marketing, so on and so forth. You got agentic AI to talk about. These are marketing agents, so on and so forth. And so I don't think it's a coincidence that the group that's been hardest hit has been recent college graduates, because that's the group that AI would most influence or impact in the job market. By the way, also another group that's been very much impacted are African-American women, as it turns out. That's another massive group that's been impacted. That's probably not about AI, that's about downsizing at federal agencies and so on and so on. So there are other groups that have been affected, but I think AI has had a quite major impact on certain segments of American demography. Yeah. Any questions? Yes, please.
What is your economic outlook for the next 5 years?
What is my economic outlook for the next 5 years? Here's what I would say. Here's what I think. And by the way, no one will remember my response, so that's good. I think actually the late 2020s could be quite good for the US economy. Why is that? Pretty strong demographics. So our most populous generation are the millennials. The millennials are 22% of America's population, and Gen Z, the generation younger than them, is 21%. So you've got a young population that is increasingly moving towards their peak earning years. So demographically, we actually look quite strong. And of course, that generation is expecting to see a lot of inheritance from older generations to get money to buy their first home, so on and so on. So you should see a lot of expenditures among that generation. Obviously, you got the One Big Beautiful Bill, a lot of tax benefits from that. But at the same time, what about beyond that? So now we're in the 2030s. I think we're headed for a fiscal crisis in this country. And a lot of economists talk about the year 2030, but that's voodoo economics, because these are economists who believe in these long-range cycles. They have a crisis every 50 years or so. 1930, 1980 was a terrible year, then 2030, nonsense. It doesn't work that way. But I would say this, that the 2030s are shaping up to be quite horrific for the Americans. Because in that decade, the Social Security Trust Fund goes insolvent, the Medicare Trust Fund goes insolvent, and we already have this $37.5 trillion natural debt, and it's going to be even bigger by that time. And I suspect that at some point in the next decade, the bond market's going to wake up and realize the Americans are not good for it, that we cannot pay back this debt in fully valued American currency. That when the crisis comes and the bond market wakes up to this, we can do, as a people, do three things. We can raise taxes, cut spending, or print money. What do you think we're going to do as Americans? We're going to print money all day long. And we're going to pay back these creditors in devalued currency. And of course, we're not going to default as a result of it. They got paid back, but they got paid back in devalued currency. It's going to lead to an inflation spike. It's going to lead to a stock market downturn at that time, which would probably make 2008 and 2009 look like nothing. That's my prediction. So I think next few years after this short-term economic weakness through the balance of 2025 could actually be quite decent for the Americans, particularly if we can reach more trade agreements, put some downward pressure on these tariffs. But beyond that, I suspect that we're in real trouble as a country. And it's not a fait accompli. It's just that we have irresponsible policymakers in Washington, D.C. We send some of our worst Americans to represent us in Washington, D.C. And I understand why we do that, by the way. Let's say you don't like your neighbor. Ever thought about running for Congress? Problem solved. But it leads to really bad policymaking. These people are hurting the country. They're not responsible people. They're not serious people. They can barely keep the government open. They can't even pass a budget. It's pathetic. It's not how you run the most powerful country on the planet. It's not how you do it. But they do this every year, and they make no progress. In fact, if anything, they're backsliding in terms of how they work together. So I think at the end of that has to be some kind of crisis. And I think it's not now, but at some point in 2030s, watch out. Any other questions or maybe something a bit more upbeat? How can we make this better? It starts with leadership. You need a better quality leadership. I would say, one of the things we have in this country, this gerrymandering, which has produced politicians on the far right of the spectrum, because you're running in a Republican primary, you got to be to the far right, or left of the spectrum, so you got to be to the far left. The middle, that moderate Republican, that moderate pro-business Democrat, they've disappeared. And so the center has broken apart. We need to get that center back, because that's when we're best as Americans, when we compromise, we work together, we get budgets passed on over, and we like each other. We don't villainize each other. But as long as we do this, always play these, sort of game theory games so that make the other party look bad, right? That's happening right now. We're going to threaten a federal government shutdown. So Mike Johnson, the House Speaker, passes a budget, gets a budget done. Now the ball's in the Democrats' court. So now the Democrats are faced with the question, do we shut down the government by pushing for what we want, or do we just give in? And so this gamesmanship is all the time, but it doesn't lead to good policy making. So we need a higher class of public officials. Unfortunately, I don't think we're going to get that. Because of all this political violence, who is talented, who is successful in the private sector, for instance, wants to run for office? Who wants to jeopardize the health of their families, the well-being of their families? So who are you going to get? You're going to get people who are suffering from some sort of pathology, right? They're narcissistic, they're whatever they are, but they're strange. You notice how weird our politicians are? Like, they're the weirdest kids in the classroom, aren't they? And they become elected. I mean, I don't know how this has happened. But they're strange people, right? The way they talk, the way they walk, what they say, it's bizarre. So anyway, I'm very nervous for our country. And, it might take a crisis to get us back together again as a people. But we haven't had that kind of crisis. We've come through it pretty well, all these COVID, Great Recession. So we came back eventually. I'm very, very nervous for our country because I think it starts with leadership, and I think the quality of leadership, I'm talking about Congress mostly, by the way, is very, very poor. So we need a higher quality of official. Any questions here? Boy, it's getting worse. This is getting worse and worse. Hey, thanks a lot for the opportunity. It's been a privilege. Thank you so much.